Today, we're looking at deal activity, which has remained pretty strong despite the higher for longer interest rate narrative. Tom Miles is Morgan Stanley's head of M&A in the Americas, and he joins us now. And what's fascinating here is even though you've seen some activity, some larger scale activity come back to the market, there have been some spots that have been alarmingly quiet. And I think if you look around the market, a lot of questions surround when private equity in particular will come back.
Well, private equity activity is well below what it was in 21 and 22. But if you really look at it, private equity activity is kind of what it was in pre-COVID times. So take 2016 to 19, and that activity isn't terrible. It's not active. It's just not as active as we got used to it being. And so you do see a number of things happening on the buy side of private activity, where you're seeing private equity firms buy public companies. Just in the last 2 months, we've seen 16 public to private deals happen over $1 billion. And so you're seeing activity. It's just not what we're used to seeing. And so over the last couple of years.
So what matters the most here? Is it the fact that we're still in that higher interest rate environment, or is it valuations? Where is the disconnect still remaining compared to the last couple of years?
I'd say there's three aspects. You've got definitely rates. So rates are higher for longer. If you recall, when we talked about in early 24, this expected boom of private equity, it was based on rates coming down. Rates have not come down. So cost of capital is higher, and that makes it harder for buyers to afford what the sellers want. Second thing is the business performance. The visibility on earnings and outlook is tougher to get buyers and sellers to agree. You've got inflation, you've got COVID era issues in companies, and you've got supply chain issues. So getting buyer and seller to agree has been difficult. And then finally, we don't talk about this as much, but in 21 and 20, the first half of 22, we saw probably 2.5 years of activity in less than a year and a half. And so if you had a company that was going to be sold, that sort of pulled forward the activity. And so there was a lot of transactions that happened in 21 and 22 that probably would have normally happened in 23 and 24. And so you've got a big inventory of companies that are owned by private equity that are only 2.5 years old into their investment. So you're going to see those come in 25, 26, and 27 for sure. And so from a market perspective, while we would all love it to happen right now, we expect the activity to be strong, durably strong over 25 and 26 and 27. If not right this moment from a seller perspective.
So you're kind of waiting a while to see those deals come to fruition, and it really raises the question too, we're at halftime. We're almost halfway through the year, and you're only seeing deals really above 10 billion, nothing above 35 billion really. So what's going to define deal making for the rest of this year?
Well, I think deal making for the rest of this year I think it's actually quite healthy, right? So you talk about nothing over 35 billion. But there's, I think, 16 deals year to date over 10 billion, which is as good as any other year has been. So M&A from a large company perspective is still a really important strategy. They're deploying the capital into M&A. They're going to keep doing that. And so whether it's 10 billion or 12 billion or 14 or 20 billion, that's going to define the rest of the year, which is corporate activity continuing to put capital to work in M&A across the globe.
Tom, how much are Biden's antitrust cops keeping away that large-scale deal-making?
The regulatory environment is unfriendly from an M&A perspective, and they've made that is intentional from that perspective. I'd say companies, boards, bankers, lawyers, we've generally adjusted to it, because if you look at it, and it's not that the rate of deal blockage has happened at a higher rate than history, it hasn't, but it has. There's no doubt that a number of deals that would have or could have been considered prior to this administration are not being considered. And the risk associated with either a long review or an unpredictable review is keeping people from doing certain things.
So is 10 the new 50?
So I think maybe 20 might be the new 50. You haven't seen a deal this year over 35, as you said. If you go back the last couple of years outside of energy, you really haven't seen something over 40 or 50 for a couple of years now. And so, yes, very large deals are going to attract scrutiny, and so they're harder to do. It's not that they're impossible to do. I wouldn't say we're not going to see those kind of deals. I think you very well could see those kind of deals. But they take a little bit longer to come to fruition. And remember, not only regulatory, a lot has to go right for a deal that size to come through. Valuation has to be right. governance has to be right. It has to be right for each company. So I think you will continue to see those deals. There'll be fewer because you got to get all those vectors have to be exactly right to have that be successful.
Tom, how much are your clients currently talking about the election cycle as well? Are some of them waiting to get past the election cycle for certainty, or even trying to rush things through before we hit the cycle in full swing?
You know, it hasn't been, I will tell you, it hasn't been a big driver of M&A discussion. That may surprise people, but it really hasn't. M&A as a strategy for corporates is a very long-term strategy. So an individual election isn't going to, generally speaking, drive that activity. So I think that's the main driver. You do have a situation where each of the candidates has been president before. So if I'm a board or a management team, I've operated in that environment before, and that could be another driver why you see, why it just hasn't been a big driver of discussion. And the things historically that have driven people to act quickly or slow down are big policy differences or big policy changes. And, obviously regulatory might be one of those. You'd expect a little bit of a different environment if you were in a Republican administration. That won't be instantaneous, by the way, so that's not going to drive someone to do something right this second or wait just till after the election. And then the other one would be taxes. That's one where if you had a higher tax rate environment in one administration or another, you might see people move more quickly to monetize assets ahead of that increase in rates.
So with our remaining time, I'd love to talk a little about sectors. Are there certain sectors that are more or less favorable for deals right now?
Well, if you look at over the last 18 or 24 months, the energy sector, it's undisputable, right? The energy sector has been very active, very large deals. Many of the largest companies have done large deals. And again, that's in a slightly different regulatory regime. So you've got the freedom to do that. And we've seen a lot of that. And that has been certainly the biggest sector from a value perspective, a volume perspective. Technology's made a bit of an increase relative to at least last year, where it was very much more challenged to get buyer and seller to agree. So we've seen technology rise off of its low last year. And then financial institutions is probably the third, and I say that broadly, financial companies is probably the third area where we've seen a lot of activity. So those three areas have been the most active. And we would expect, I don't know how long energy can continue to do all of the deals they're doing, but we would expect certainly tech and financial institutions. And then we would expect healthcare to come up into that grouping as well.